Okay, we're going to wrap up chapter 10 with learning objective 4. Um, and it's actually, we're going to be doing a little bit of math. Woohoo! Because we are evaluating performance in the investment center. Investment centers have unique responsibilities that are different from a cost center and a profit center because they actually have investable monies. Um, and that means that they can do things like put up more stores for a company or invest in other assets that, again, you want a return on. So the return on investment becomes the critical feature in how to evaluate the performance of a manager in charge of an investment center at a company. Okay. So ROI is going to be the thing for learning objective 4 that you're going to need to focus on here. This is the skill. This is the financial ratio that we use. Again, we're looking to show effectiveness of the manager that has a lot of assets at his or her disposal. How do they make those investments? Or is it paying off for the company? And all the factors really are controllable by the manager in most cases. So, how do we calculate return on investment? It's actually quite simple mathematical formula by most. You take the controllable margin and you divide that over the average operating assets. Notice the word is operating assets, not total assets. Um, and that's important to know. Okay. And that gives us our return on investment. So if you want to look at what page do you want to look at? The top of page 432. Okay, so if you have your book and you go to page 432, you will see a bunch of numbers there that will tell you that this company had a controllable margin of $1 million over assets, operating assets that average $5 million. So they had a 20% return. That's really important. Operating assets are current assets and plant assets that are actually used in the operation. Okay. So it does not include the other types of assets, but just the ones that are involved in the operations of the company. Okay. Okay. In order to get the average, by the way, as it says here, it's the beginning and ending book value of those assets on the balance sheet. Okay. So for the most part, an investment center is somewhat of an independent entity for operating purposes. And so all of the costs are controllable by the center manager. And they also do the same thing. They have budgeted and actual data that's listed, but the way they evaluate the data is based on return on investment. Okay, so you'll see that. And here we go. Here's illustration 1024, also on page 432 at the very bottom here. Here is the exact same report we saw from the Marine Division of Mantle, showing the budgeted amount and the actual amount for the year that ended December of 2017. What you see here is some added lines. The last time we looked at this, we stopped at controllable margin. Okay. What you did not know is what they're telling you here, that the average assets are $2 million. Okay, that's the average assets for the Marine Division here. So if you had a controllable margin of 300,000, which was what they were expecting, that's the budget, on $2 million of operating assets, you would have got a return on investment of 15%. Right? In actuality, they actually only had a controllable margin of 264. They still had $2 million of average operating assets. So that's going to get a return on investment of 13.2%, which is below the 15% by 1.8. Again, it's an unfavorable outcome for this particular division for this particular year. But as you notice here, as a investment center, the return on investment is going to be the primary evaluation method here. So you're going to be calculating this. Actually, you see, it's not that difficult to do. They tell you a little bit about, the valuation of the operating assets, and how they measure controllable margin and margin in general. But oftentimes in the book, it's going to be provided for you. Okay. I don't want you to get tied up in too many details at this level. If you keep going on in accounting, you will get tied up in the details, and it'll help you. So improving our ROI, return on investment, you can do that in a few ways. One, you can increase your controllable margin. That'll provide you with a higher return. You can also reduce your average operating assets. Either way, that's why it's an and or. Either way, you're going to increase your return on investment. So if you look at a company that had $2 million in sales and 1.1 million in variable costs, they had a $900,000 contribution margin. 45% is their contribution margin. After you take away their controllable fixed costs, their controllable margin was 600,000. Okay, 600,000 on assets of 5 million gave them a return on investment. It's this number divided into that number of 12%. Could that be any better? How so? Well, one thing they can do is, well, what if we increased our sales by 10%? What if we increased our sales by 10%? Well, if they increase their sales by 10%, they would have $200,000 more in sales, because $2 million in sales increased by 10% would give you 2.2 million. Your contribution margin would increase 90,000. Okay. And so your controllable margin goes from 600,000 to 690,000. 690,000 divided by those same $5 million of average operating assets will increase your return on investment to 13.8% from 12%. Obviously, this is a better number. Okay. So that's one way to do it. Increase your revenue, which increases your controllable margin. You could also look at expenses. If you can't get the revenues up, get the expenses down. Let's say you decrease your costs by 10%, variable and fixed costs by 10%. Well, now your costs are going to decrease by $140,000 in the example we looked at. So now your controllable margin is going to be $740,000, because by reducing costs by 140, you add that to the 600 that's already there. So that's 740 total. You still have the $5 million of average operating assets, and you boosted that number dramatically to 14.8%. That's much higher than 12%. Okay, so this has a little bit bigger bang for the buck than increasing your sales, but either one, it's an or, will get you to a higher return on investment. Okay. Lastly, one thing that could happen is you can actually reduce your average operating assets. Okay. Let's assume in this case your average operating assets are reduced by 10%. So instead of $5 million, they are reduced 10%, which is 500,000. So they're now 4.5 million instead of 5 million. Your margin, your original margin was 600,000 from early on. So 600,000 over the 4.5 million gives you 13.3%, which is higher than the 12% we started with, right, in our budget. So either way, this is how we can increase our or improve our ROI. Okay, so this is how this section ends. A do-it exercise for, in this case, the service division of Metro Industries. It gives you information on sales, variable costs, controllable fixed costs, and average operating assets. Right, that's an important number. So in this case here, management is considering the following independent courses of action in, it should be 2017, because I have the wrong number, the wrong date here, in order to maximize the return on investment. One, they want to reduce average operating assets by 80,000. Reduce this by 80,000 with no change in the controllable margin. Or two, increase sales by 80,000. Again, with no change in the contribution margin percentage. Okay. So the first thing we need to do, A, compute the controllable margin and the return on investment, if that happened. And B, compute the controllable margin and expected return on investment. Okay, so let's find out. First up. So in this case, we're using, and this is on page 434, by the way. In this case, we're using our original data that's presented in the problem. Sales were 400,000. We subtract the variable costs of 320,000. That gives a contribution margin of 80,000, which is basically a 20% contribution margin. Right? We're subtracting out controllable fixed costs of 40,800, leaving a controllable margin of $39,200. When you put that over the average operating assets of 280, we're looking at a 14% return on investment just to start the year with. But what if we made those changes? Okay, so if we actually reduced our average operating assets by $80,000, that would increase our return on investment to 19.6% because you'd have 39,200 divided by 200,000. So that would be significantly higher. Well, what if you went ahead and boosted your sales accordingly? And the second thing they wanted you to do, right, increase sales by 80,000. Okay. And so you would go ahead and have a contribution margin of the same percentage, 96,000 is 20% of the 480,000 in sales. Right. You would take away the fixed costs. Your controllable margin is now $55,200. And that would be divided by the original 280,000 of average operating. And that would boost up your return on investment to 19.7%, so just slightly higher. So again, they're going to ask you to calculate this to usually one decimal when you actually go ahead and do this. And remember that contribution margin as a percentage of sales, right, will stay the same. In the original, it was 20%. In this one, it's 20%. So just remember that. Okay, and we're back to our main screen, and I'm open for questions.